You're coming in to see us soon, and during that meeting, we're going to provide you with an updated investment policy statement. Now, you know this important document is really the architectural design of your portfolio. Everything that's been done investment-wise is based in that document. We're making a change for two reasons. First of all, we are going to enhance your international diversification. You are already extremely well diversified, but we're going to take that one step further, so more international diversification. The second point we're going to be trying to address in the investment policy statement is normal market ups and downs, volatility. Volatility is part of investing, and the more we as investors understand volatility, I think the more enjoyable the experience will be.
Having a well-structured financial plan is a key element to your continued financial success. Within that financial plan, having very strong investments and the proper implementation is key. We design all of our portfolios using evidence-based investment, which harnesses the academic research that's been done on investing and how the markets work. And we're harnessing all of this information and implementing it into our portfolios.
Let's start with the basics. How do prices get determined for stocks? Well, every day around the globe, there are about 500 billion transactions. Each transaction has a buyer and a seller, and together they independently agree on a price. That is the best proxy for the value of that stock. We do not recommend trying to anticipate or guess, speculate the market to get ahead of that natural process. Think long term, embrace market pricing. That's our recommendation.
Different types of investments have different characteristics. Bonds are considered less risky than stocks. They have reduced volatility, but we also would expect a reduced return over the long term. Let's look at this graph starting from 1926. If we had invested $1 in government bonds, it would be $142. If we had invested it in US large companies, it'd be $7,000. Small companies, $20,000. It's all relative to risk and return. The chart is really misleading because it's looking at such a long time period. So it makes the investment experience seem very smooth and stable and always going up. But when we take a shorter time period, what we see is that the volatility is actually a lot. There's a lot of movement in the market on a daily basis, and that can make investors feel very uncomfortable at times. So what's important for you is having the right asset allocation. Having that combination of stocks and bonds that's right for you and your objectives is going to, one, affect the investment experience you're having, as well as achieving the objectives you want to have in your portfolio. Diversification is very important in your portfolio, and you have been well diversified. Two of the many reasons why diversification is important is, one, it can increase the return if you are diversified globally, and it reduces the volatility. Take, for example, a time period ending in 2018. The Canadian markets returned 8%. That same time period, a global portfolio returned 1.5% higher with a reduced volatility.
The next chart we're going to show you looks a little bit like a checkerboard. What we have done is taken 9 separate investment classes and ranked them over quite a number of years, ranking them top to bottom. Look how randomly the returns happen every year. We think it's impossible to, in the short term, speculate at what's going to be the winner next year. That's why your portfolio, as it stands, is very, very well diversified and invested for the long term. When it comes to diversification, we want you to think globally. Now, you already have a very globally diversified and therefore safer return. But if you look at a global map, not of land mass, but a global map based on economic activity, Canada, we're a pretty small fish in a pretty big pond. We only account for about 3% of the world economy. The States is a little bit more than half, and there are other significant economies elsewhere in the world. So the change that we're going to be recommending to you is to take international diversification one step further and enhance that diversification. We think that's going to be much safer for you. There's one problem with chasing past performance of mutual funds. It doesn't work. We looked at mutual fund managers investing in stocks starting in 2008. Everybody that buys mutual funds wants to buy a good mutual funds, and they naturally buy the mutual funds with the best performance. So if you take those top quarter managers and look at how they performed over the next 5 years, you'll be very disappointed in the results. You'd expect by chance that at least 25% would remain in the top quartile. That was not the case. Only 21% of managers that were initially for 5 years in the top quartile remained in that top quartile going forward. That's why your portfolio buys good long-term funds and then doesn't try to jump around based on historic short-term results. Better for you, safer for you. The biggest risk to investing is human behavior. Now, what we're going to show you now needs a little bit of an introduction. Of all the evidence that I have seen in many decades in investments, this is the most discouraging. The dark color shows the return of the US stock market from a 1-year period to a 30-year period. Look how well the stock market has done. The light color is the actual return of individuals that were participating in the market during that time period. They have done perhaps about as half as the market. Why is that? Markets do fine, individuals do not. A lot of panic comes into play. You set up a long-term plan and then you forget the long-term plan when you have normal market volatility. That's why your investing over the years has been a long-term buy and hold. We're not trying to anticipate things. We want to capture market returns. We don't want to try to be afraid and therefore avoid what the returns could be. The solution is simple. Do what you've done. Have a plan, put it in writing, and invest for the long term.
We hope you found this video both enjoyable and educational. We wanted to share some of the evidence investment principles that go into making up how your money is invested.
Your wealth manager is going to discuss this with you the next time you're in. If you ever have any questions for either Jennifer or myself, be happy to talk anytime.